Do you want to invest your money but have no idea where to start? Maybe you've saved a little bit of money, but you're not sure if it's enough to begin investing. Or maybe, like many others, you've heard about stocks, bonds, crypto, and other investment options, but feel completely lost in the sea of information. The good news is, getting started with investing doesn't have to be overwhelming. In this video, we're going to break it down into simple steps so that anyone, whether you have a little or a lot of money, can begin investing today. By the end of this video, you'll understand the basics of investing, why it's important, and how you can take your first steps into the world of investing. Let's jump into it. Part 1. Understanding the basics of investing. So, what is investing really all about? At its core, investing is about making your money work for you. Imagine saving up $1,000 and putting it to work instead of letting it sit in a bank account. This is what investing does. It takes the money you have and allows it to grow. With the power of compounding, your initial investment can grow much more over time. Think about inflation for a second. Over time, the value of money decreases. So, if you have $1,000 today, it might buy you a new laptop, but in a few years, that same $1,000 might not buy you the same laptop due to inflation. By investing, your money has the potential to grow and combat the impact of inflation. As your investment grows, it can keep pace with rising prices, and in many cases, outpace them. But how does money grow through investing? There are a couple of ways. Let's say you decide to buy a house. The house doesn't just sit there. It might earn you rental income if you rent it out. Plus, the house's value may increase over time. So, if you buy a house today for $100,000, you could be renting it out for $1,000 per month, and in 10 years, the house might be worth $150,000. This is how you can build wealth, even in uncertain times. With other investments like stocks, you don't get rental income, but you hope the value will increase over time. The goal is to buy something at one price and sell it at a higher price. Stocks are a popular option here, and we'll dive into that in the next part. But remember, no investment is risk-free. So, it's always important to think carefully about your options. Part 2. How to invest in stocks and shares. Now, let's talk about stocks and shares. When you buy stocks in a company, you're buying a small ownership stake in that company. This means that if the company does well, you could make money by selling your shares for a higher price. Owning stocks is like being a mini owner of a company. You share in the company's success, but you also take on some of its risks. But how does it work? Let's use Apple as an example. If you bought stock in Apple, you're not just hoping the stock price rises. Companies like Apple also pay out dividends, which is a portion of their profits given to shareholders. This is like getting rental income for your shares. So, let's say Apple pays a $5 dividend per share each year. If you own 10 shares, that's $50 in your pocket every year. Even if the stock price stays the same, dividends are a great way to earn passive income without having to sell your stock. Investing in stocks is not just about picking any stock. You need to choose wisely. It can be tempting to pick the next hot stock like Tesla or Amazon, but remember that picking stocks requires research. If you're a beginner, this might be a bit tricky. That's why many experts recommend starting with an index fund, which we'll explain next. Index funds allow you to invest in a variety of companies without having to pick them yourself, making them an excellent choice for beginners. Part 3. Index funds and why they're perfect for beginners. An index fund is a type of investment fund that tracks a particular market index, such as the S&P 500. The S&P 500 includes the top 500 companies in the United States, like Apple, Microsoft, and Amazon. When you invest in an index fund, you're essentially investing in all 500 companies at once. This means your money is spread out across many companies, reducing risk. If one company's stock goes down, the others might go up, balancing things out. This helps protect your investment from the big swings that individual stocks often experience. For example, if you invest $1,000 in an S&P 500 index fund, your $1,000 is automatically spread across all 500 companies in the index. This is a safer way to invest, especially if you're a beginner and don't want to pick individual stocks. Index funds are a low-cost, low-effort way to invest and generally provide steady growth over time. They're also incredibly simple to buy, which makes them an excellent starting point for new investors. It's also important to know that investing in the stock market isn't a get-rich-quick scheme. The market can go up and down, but over long periods, it tends to increase in value. If you're investing for the long term, like retirement, index funds are a great option. The key here is patience. Investing for the long haul means your money has time to grow and recover from any short-term losses. Part 4. Fast lane investing, a different approach to wealth building. While traditional investing, like putting money into index funds, is often referred to as the slow lane of wealth building, there's also the fast lane. Fast lane investing is a more aggressive approach where you focus on growing your money quickly by investing in yourself or building your own business. If you're someone who wants to achieve financial independence sooner rather than later, this approach might appeal to you. For example, let's say you're working a regular job and you're saving a portion of your income. Instead of just putting that money into an index fund, you might consider investing in a course that teaches you a new skills that could help you earn more money in the future. When you invest in yourself, you can increase your earning potential. If you take a course that helps you get a promotion or land a higher-paying job, that's a return on investment far greater than the 7% you might get from an index fund. It's all about improving your skills and earning more over time. Another form of fast lane investing is starting your own business. By owning a business, you have the potential to make money far faster than traditional investments allow. Of course, this comes with higher risk, but it can also lead to much higher rewards. Many successful entrepreneurs didn't get rich by buying stocks. They built businesses that generated substantial income. Part 5. Common fears and questions about investing. Now, you might be thinking, what if I lose all my money? This is a common fear, and it's important to understand that investing does come with risks. The stock market can go up and down, and there's always a possibility that you might lose money, especially in the short term. For example, during the 2008 financial crisis, many people lost a lot of money in the stock market. But here's the thing. If you had invested in an index fund like the S&P 500 back then and held on through the rough times, your money would have eventually grown back and increased over time. The key to overcoming this fear is to have a long-term perspective. Don't invest money that you can't afford to lose, and don't panic when the market drops. Over time, the stock market generally goes up, and your investments will likely grow. Another question beginners often ask is, how much money do I need to get started? The great thing about investing today is that you don't need a lot of money to get started. With platforms like Vanguard or Trading 212, you can start investing with as little as $5 or $100, depending on where you live. Part 6. How to get started. Now that you understand the basics, you're probably wondering, how do I start? Getting started with investing is easier than ever. First, choose a reputable investment platform like Vanguard, Charles Stanley, or Trading 212. These platforms allow you to open an account and begin investing in stocks, bonds, or index funds. When you're starting, it's a good idea to invest in an index fund. You can set up automatic contributions so that you're regularly investing, even if it's just $5 or $10 a week. Over time, this will add up. It's also a good idea to use practice accounts if you're feeling nervous. Some platforms, like Trading 212, offer demo accounts where you can practice investing with fake money. This way, you can get a feel for the process without the risk of losing real money. Starting to invest is one of the best ways to grow your wealth over time. Whether you're just starting with small amounts of money or you're ready to dive into the world of stocks and shares, it's important to take it step by step. Don't get overwhelmed by all the options. Start simple with index funds and focus on the long-term growth of your money. If this video helped you understand how to start investing, make sure to hit the like button, share it with your friends, and subscribe to our Scale Smarter YouTube channel for more easy-to-understand investment tips. Drop a comment below any reason that's holding you back from starting your investing journey. Thanks for watching and happy investing.